Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
This podcast was recorded for publication on the 12th of June 2025 by HSBC Global Investment Research. All the disclosures and disclaimers associated with it must be viewed on the link attached to your media player. And don't forget to like and subscribe to the Macro Brief wherever you get your podcasts.
Hello, I'm Piers Bartle in London, and this is the Macro Brief, where we look at the issues driving financial markets in developed and emerging economies. And uncertainty is still dominating across the globe. Tariff concerns persist, and, in the US, debt dynamics and the promise of higher spending have heightened fiscal fears. It's a difficult backdrop for central banks such as the Federal Reserve, who meet next week. So on today's podcast, we're taking stock of what the latest news and data mean. I'm joined in the studio by our global chief economist, Janet Henry. Janet, great to have you back.
Good to be back, Piers.
So here's my sort of feeling on it. Has uncertainty declined, or have we just got used to it? It sort of feels calmer, but maybe we're in the eye of the storm. We had Liberation Day, then we had the 90-day pause, which is quite close to coming to an end. So maybe we should just firstly recap on what's been achieved during that time. There have been some trade deals. There's also been some legal challenges, other things happening. So maybe just recap on that for us first.
It's a good place to start. To some extent, we have got used to uncertainty, but also, at least as far as financial markets are concerned, some of their kind of worst case scenarios that perhaps we saw on April the 2nd, that announcement of some exceptionally high reciprocal tariffs, I think those worst case scenarios have kind of been put to bed by how quickly they were unwound. And now, of course, we've got much higher tariffs because we have got tariffs, an additional 30% or so on China on top of the 20% we already had. We've still got elevated tariffs on Canada and Mexico, and we've still got a broad 10% tariff on the rest of the world and higher tariffs on a number of sectors. Remember, we've got those tariffs on cars of about 25%. And of course, part of President Trump's frustration with the International Court ruling on how unlawful his use of emergency powers were meant that he quickly came back with an increase in steel tariffs from 25% to 50%. But, your overall point about have we got used to uncertainty, I think looking at the S&P, equity investors in the US seemingly have got used to the uncertainty. They take the view that actually a lot of this is negotiating tactic. A lot of people argue that for large companies in the S&P, perhaps 10% tariffs or so is largely priced in. Obviously, as an economist, I have to be worried about non-S&P 500 companies. A lot of people in the US work for smaller companies, and the fact is tariffs will be feeding through into the economy. It just might take time, and it may not be the largest companies. It may be some of them, the smaller, more vulnerable companies that see a bit more of the pain.
So let me challenge you on that, because it's fair to say that the data from the US has proved more resilient than expected. After all, in your global chart book, which you've just published, you entitled a section on the US charts, US activity is still chugging along.
The hard data are, but, when I go around the world talking to investors, and certainly I had a week in Asia in the middle of May, the question I got in every meeting was when, if ever, will the hard data follow what was absolutely tumbling soft activity data? Some of those consumer confidence indicators, even some of the business confidence indicators, they had fallen to levels we had not seen since the onset of COVID. In March 2020, they had absolutely imploded. But as the tariffs, the worst reciprocal tariffs, were scaled back and the markets recovered, what we saw in the May survey data was either stabilization or some improvement. But the hard data, and in particular the labour market data, because of course last week we had the payrolls release, still registering an increase in employment, at least on payrolls, of over 100,000, and we did see an increase in wage growth. Wage growth came in higher than expected, and while we saw in the April retail sales data goods spending did fall back after the surge in some consumer goods ahead as part of this front-loading bounce, actually, even though goods spending fell in April, service sector spending actually rose. So yes, the hard data has still remained very resilient. We would argue that there are some signs of cracks starting to come through. The household survey showed a big drop in employment. There are fewer sectors now generating the jobs that we are getting in the US. So yeah, around the edges, there are some signs that things aren't quite as strong as they were. Initial jobless claims are rising. But yeah, market participants always want to know here and now exactly what's happening, but we're going to have to be patient in this. It's going to be a volatile ride for data, and we will see it all play out in the coming months.
The other thing that happened since Liberation Day was that one of the key rating agencies, Moody's, downgraded US debt from the sort of AAA that they had. Was that more related to the Big Beautiful Bill Act?
I think it was a broader assessment of the fiscal dynamics underway now in the US, and perhaps the final catalyst was what is embedded within the Big Beautiful Bill Act that's now been passed by the House of Representatives and is making its way through the Senate. Of course, this loss of the AAA rating from Moody's comes more than a decade after other rating agencies had already actually downgraded it, and as is often the case, financial markets had already priced in a bit more of a term premium into the Treasury market because, we are looking at a bill that's going to increase the debt stock quite significantly by, arguably over $3 trillion over the course of the next decade, and some pretty big tax cuts being involved. And when you've already got quite a large budget deficit, and in the coming years are projected to maybe be spending 4% of GDP on interest payments, and your debt to GDP ratio is already 100%, the fiscal dynamics just on any long-term projections look very, very worrying in a lot of people's eyes, even if the US is still the world's reserve currency.
Is that what the bond market is telling us in terms of the level of yields?
Yeah, I think, when you're looking at short-term yields, obviously what's expected to happen regarding short-term interest rates is the primary driver of, for instance, the 2-year yields. But you always have this measure that's very hard to assess in real time regarding a term premium that can reflect what's happening regarding inflation uncertainty, but also, fiscal dynamics play a role. We see it in emerging economies. The UK had its own recent experience in recent years, but now, yes, it would appear that the fiscal dynamics have been playing some kind of role in terms of what's happening in longer term interest rates.
One of the uncertainties in the US, to finish on, is what the Fed is likely to do with interest rates, and there's been a lot of anticipations about Fed rate cuts and then putting back, and we've just had inflation data. Where's the Fed now?
Well, you're right. We have just had inflation data. And again, this is 2 months in a row for April and May that inflation surprised on the downside. So both headline and core inflation only rose by 0.1. I mean, we're still talking about core inflation that is at 2.8%. It is a little bit too high. And maybe there are a few signs of a little bit of tariff effect on certain items, certain parts of household goods, for instance, toys and such like. And we know a lot of toys come from China. So, but the inflation numbers have been relatively benign. But I think, Christine Lagarde at the ECB meeting said that basically you can pack your bags for the beach now. You can wait for the summer. It's going to be a very quiet summer. It would appear it's going to be quite a quiet summer from the Fed as well. They absolutely will make it clear that they can wait and see. Yes, they have a dual mandate, but they are still at full employment because the non-farm payrolls release still showed unemployment unemployment at 4.2%, and inflation, while it has not been as scary as some had feared it might be on the back of tariffs, because some of it's weighing on demand, some of it's weighing on profits, and only a small amount so far has gone through into prices. But maybe, we will run out of inventories and you'll see it in June and you'll see it in July. So the Fed absolutely waiting to see, and really they will not be cutting interest rates until they see more slack emerging in the labour market in terms of the unemployment rate rising. But of course, the other uncertainty there is not just whether there is lower demand for workers, because I think there is lower demand for workers. We see that in the data. But you've got this enormous uncertainty regarding immigration in the US. So even slower demand for workers might still mean that the unemployment rate does not rise as much as we are forecasting, which is to over 4.5% by the end of this year.
Let's leave US shores and firstly on the UK. I mean, there's been a lot of headlines about this spending review. Does that matter? Should we be worried about it? What's your take on it?
Well, you're right. There have been a lot of headlines about it because, one of the big stories across Europe has been, the need to spend more on defence. So we did get an announcement regarding how the future fiscal envelope will be spent. We've already had the budget. We had the budget last year, but this is when they set out the detailed spendings. So there will be higher spending on the health service and there will be higher spending on defence. And then it suggested how things were going to be spent, which basically meant cut in a large number of other sectors. But I don't think it is the major issue currently. Actually, this week we've just had the UK GDP release. And I think this is where there is a kind of global element. It's just that we get monthly data from UK GDP. And we had an exceptionally strong first quarter. As the government likes to say, about the strongest in the G7. So quarter-on-quarter growth was very, very strong in the first quarter. In fact, I wrote a piece called The Front-Loading Bounce, because remember, the US contracted in Q1, and large parts of the world surprised on the upside, China, Europe, and the UK. So what we saw in the UK is in April, the awful April payback, the end of the stamp duty reduction. So we had seen a lot of front loading, not just in terms of ahead of US tariffs on the export side, but actually in terms of house purchases. So we've seen the element there. We've also seen the impact of higher national insurance contributions for companies. So you've had a lot of tax increases. So you've had a kind of domestic payback, as well as what a lot of the world will see, which is the global payback after the front-loading bounce in imports. But actually, it's that latter point elsewhere that could potentially be more important, because this 90-day pause, if it does prove to be a 90-day pause, because there's now been a suggestion the reciprocal tariffs could come back in a little bit sooner. We just don't know where we are with that. But we look at, for instance, the Taiwanese trade data for May. Taiwan's exports to the US in May were up about 87% year on year, and I don't think anyone thinks that will continue. But it will be some time before the trade data is telling us anything really sensible after this bounce, the payback, the renewed pause. It really will be later in the second half of the year before we get a better idea on the trade front.
I have a follow-up question on that vis-a-vis clients. But firstly, let's just finish on looking outside of the US. And you mentioned earlier Christine Lagarde and coming to the end of the rate-cutting cycle. Do we still see Europe as a beneficiary of the end of US exceptionalism? I realize it's a big question and we don't have a huge amount of time, but nevertheless, it is still something in people's minds.
It's certainly a discussion point in client meetings. We have had this overall market view for some time now of US exceptionalism. Growth has significantly outperformed. US companies, particularly the Magnificent Seven, have obviously made extremely strong profits and have grown very, very quickly. So I think, a lot of investors that have had a really big overweight in the US, they're not selling down everything, but they are perhaps thinking maybe they need to reduce they're overweight to some degree. So I think particularly regarding people that invest heavily in sovereign bonds, they are looking at other G10, and the Eurozone is the biggest within that. So you've obviously seen what's been happening in particularly Southern Europe, Italy and Spain, and even Greece. You've also seen people maybe even looking at Japan and Australia and other regions of the world where the Eurozone's already seen big rate cuts, and what we expect to happen in the coming year with the tariffs in the US is that it will be deflationary elsewhere. So we're looking for a lot more rate cuts in Asia. We think the ECB is probably done. It's possible we get one more, but it's certainly taking the summer off. But because we don't look in a significant weakening, then a lot of investors are looking to reallocate a little bit more to Europe, but also to other countries in the world as they gradually reduce their US overweight at least a little bit.
Let's finish the sort of globe-trotting tour. The story out of Asia is stabilization in China.
Well, in China, what we saw in the first quarter was a stronger than expected GDP figure. And some of that was supported by stronger exports to the US in anticipation of tariffs. But of course, the tariffs on China took effect before Liberation Day, some of those initial tariffs. So this is why it all happened a little bit earlier in China. And also in China, we have seen the continued rollout of additional measures to support domestic consumption. So far, we've only had the April data for trade, and it does look like China exports to the US fell back. It was much more resilient elsewhere. In fact, Chinese exports to Europe actually improved a little bit in April. But if they're not going to be able to rely on exports quite as much, and China is still in deflation, then there will need to be further measures to support the consumer story within China, even as they seek to develop other export markets and to grow their market share in other economies as well. But certainly, the April activity data, broadly, it slowed. It just didn't slow as much as had been feared on either investment or industrial production. That also surprised a little bit on the upside.
So coming back to this question, in terms of all your interactions with clients, you see the full range of wealth, corporate and institutional. I'm particularly interested in your conversations with corporates. And the question here is, as you mentioned earlier in the conversation, they're all waiting on the data. They're waiting to see whether this tariff shock is really going to come through. Is there a risk that they're waiting too long and they should be acting, or are some of them already taking decisions on investments on the back of what's happened?
It's a whole mixture, really, because what you've got to remember, there are some structural stories still underway in the global economy. So, when you look at the outlook for the year ahead, you've seen all the forecasts coming through from the OECD and the World Bank. Everyone's been lowering their growth numbers. This is not good for global growth. But there will even cyclically be relative winners and relative losers. So even just on the cyclical front, some countries are saying, OK, maybe things are going to be harder in terms of exports to the US, but where can we grow our exports? Where are the most rapidly growing Asian economies and, big economies with large populations? So can they be excited about the Philippines or India? Or indeed, what's happening, for instance, in Latin America, where they are less exposed to the US, some economies, and it's more about the domestic stories. So they are looking beyond the US, particularly if they are in the export front. Broadly speaking, uncertainty is bad for investment and bad for employment and decision-making everywhere, I think, in this world. But also, when you're thinking about stories regarding AI and such like, or building data centres, that doesn't come to a halt. Yeah. Just because global demand is going to be weaker. These are decade-long stories where you have to keep investing, and that's where I think you're not seeing the story change.
That's, I think, a positive note to end on, and I hope we have a quiet summer, but I'm not entirely convinced that we will. But at least for now, thank you for joining us.
Thank you very much, Piers.
HSBC is hosting a major conference in London next week on the Gulf economies. This covers Saudi Arabia, the UAE, Qatar, Kuwait, Oman, and Bahrain. Ahead of the event, our team has published a comprehensive outlook for the region, laying out our macro, strategy, and sector views. It also delves into key themes such as shifting demographics, investment in future cities, and expanding trade connections. Remember that HSBC clients can keep up to date with our latest research by downloading our app from Apple's App Store or Google Play. And we'd love to hear from you. So if you have any questions or comments about anything we've talked about, you can email us at askresearch@hsbc.com. And if you've enjoyed today's edition of the Macro Brief, then please like and subscribe wherever you get your podcast. So that's a wrap. Thanks very much for listening, and we'll be back next week.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.